Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Welcome to the Real Estate Risk Report. I'm your host, Lance Pederson. Thanks for joining me. This is episode 1. So today, as we get started here, just want to cover what the topics of the day will be. I got a lot to run through. So for today's show, I'm going to start just kind of share a little bit about myself, why I'm doing this, what makes me qualified to host a show like this. I'll also explain the reason behind the name of the show, Real Estate Risk Report, why we came up with that. We'll do a run through, sort of an overview of what risk is in general, touch on some of the ways that one can lose money investing passively in real estate investments. And then we'll discuss a little bit about the format of the show going forward, try to give you an idea of what you can expect from future episodes. So this particular one will be a little bit of sort of housekeeping, setting the table for what we're trying to do, going forward. So looking forward to it. So I guess, just starting out with the rationale behind why I'm doing this, so why does the world need another podcast? It's obviously sort of a trendy thing to do these days. And that's good. I think people are picking up on it, and it's a great way for them to consume content. So looking forward to being a part of this. But I think that fundamentally for me, and personally to take on this endeavor is that, I've been in the sort of the real estate, private placement investment game sort of since 2008. So I've been doing this a long time. And the thing I've noticed over the years is that, there's a lot of people who sort of meet the accredited investor definition who, don't participate in the private markets. And in, discussing that with them and the reasons and rationale for doing so, it's just they're intimidated by it, right? It's scary, the decision to invest money, especially when in a passive way, is in sort of abdicating decision-making responsibility to someone else, and entrusting your money with them is, it's a pretty big leap. And so I've kind of looked at a lot of this is a way of taking, help. I mean, I'm hoping that the show can help take people from, being ignorant to becoming enlightened, right? And in this case, the word ignorant to me is just, you don't know, right? It's just not knowing. And in this case, the not knowing and understanding is what causes you to not participate. So I think that from my standpoint, it's intimidating because there's lots of big words and people that do it all day long. They don't know how to stop and slow down and maybe explain things more thoroughly. And I guess I think I at times fall into that category as well. So my hope is that this forces me to slow down a bit. I'm a fast talking guy and, sort of put the cookies on the bottom shelf, so to speak, right? And just take it bit by bit and make it easier for someone to start to get, a better grasp of, how all of these different component parts work and how to, more systematic way for approaching it to the point where, they get enough comfort that they feel, confident enough to make their first investment, whatever that might be, whether it's a fund, a pooled fund or a syndicated single asset, investment, whatever the case may be. Much of that stuff is what we'll talk about. And I'll try to make sure that I, define the things that I'm referring to as I go. So I think it's also important then to hit on, what makes me qualified to, enlighten all of you. And, I think that the best way to sort of, to share that, and explain that and what got me here is that just a little bit of background, I think, about myself, right? First and foremost, I'm an entrepreneur. If you ask me what I do, that would be what I would say is I'm an entrepreneur. For me as a kid, I basically got straight A's pretty much through high school. things came easily to me. I enrolled in college, ended up dropping out before the end of the first semester. I just found the parties were far more interesting than the classes. It wasn't for me, but I was one of those guys. Everyone else was doing it, for a period of time. I didn't quite know what to think of that. But what I've learned throughout the course of my life, and as kind of grips with, each of us are unique and have our own sort of things that we're good at, and obviously things that we're not so good at. In my case, there's probably more things that I'm not good at. I'm one of those people who's just, deficient in many, many ways, but have sort of a very enhanced abilities in some other ways. And so for me, my superpower is the ability to learn new things. So, especially abstract, complex things, and I can learn them very quickly. I always have. That's just how it sort of works. And I think that, throughout my life, I've realized that much of that is because I'm very observant. So I like to pay attention to everything that I see and that's going on, and to think through, why someone would have done that. And maybe at times, I've developed my own form of empathy through that, because oftentimes I observe people doing things that don't necessarily make sense to me. I don't understand why they would have behaved the way that they did, given the set of circumstances. And, so I've collected all these observations, and I tend to live in my own mind. And I often say, my best friends are my own thoughts. So that's how I am. I live in my mind, and I like to really wrestle with things. So with that sort of as the background, how I've sort of ended up here, and then developed the specific skills necessary maybe to help put cookies on the bottom shelf, and make things easier to consume, is that, a bit of background. So, I was raised in Minot, North Dakota, born and raised there. I've lived in Portland, Oregon for most of my adult life. I'm married. I've got 5 children, ages 6 to 16. As I mentioned, I was an entrepreneur. So when I first moved out here, I started my own company after working for someone else. I was one of those people who said I could do it better, and left and did it on my own. Right. And so built at that time, it was an IT managed services provider. We were basically the virtual IT department for, small, mid-sized companies. And once again, that sort of, I've seen lots of things, right? Lots of different businesses. I've been involved. You have to make a computer network run, and those things, you got to understand what the business objectives are. And so I've had a lot of reps over my life and seen lots of things and been able to put them, sort of together. At that time, I figured that's what I was, right? I'm an IT person. Well, I quickly learned that, after 7 years of doing that, it just wasn't my passion. And that, that's when I started to realize that it's more of just the entrepreneurial pursuit of just solving problems and figuring things out was sort of, my lot in life. And so I sold that business in 2007 and got involved with Matt Burke, who is one of my business partners. He and I were actually in an entrepreneurs group together. It's called EO. And he invited me to come on board for his company, which was called Fairway America, and they were commercial hard money lenders in the Pacific Northwest. And they had, an investment fund, and we're on the process of launching a new investment fund, and which was all brand new to me. And I came on board to sort of help, get the back office sort of operations in order, including the technology and those things. And so that was really my first foray into, this world, right? Which is this is the world that I'm now going to, invite you into, and hope to do a good job of sharing with you all the things that I've learned over the years, and, make that kind of, I guess give you the shortcut, right? So for me, it was net new to me, just like it may be net new to you. And, I'm going to try to do my best to expose you to content, week over week that will help you, have an easier time of learning it maybe than you would otherwise. So as of this time, right, I am still a principal in that particular company, that private equity real estate firm, Fairway America. And we also own another company called Veravest. So there's sister companies, which I could be classified as sort of the founder. of, and this is my day job, is not being a podcast host. My day job is being the managing partner of a company called Verivest, who is a service provider to real estate investment sponsors throughout this very ecosystem. So one of our, in addition to Fairway America being, a shareholder in our company, it also is one of our biggest clients. So this is sort of that unique perspective, I guess, and what makes me qualified is that, I've been involved at the Fairway America level. So I've been a sponsor, and on that side, I've walked into a situation where, sponsors trying to sort of increase their professionalism or make them sort of more institutional quality, been a party to that. And then in 2012, Matt and I decided to pivot the firm. Instead of being solely a commercial hard money lender, we decided to, we were being approached by a bunch of other real estate individuals who were looking for more, better ways to more efficiently capitalize their deal flow, right? And so at that time, in 2012, this was sort of as the Great Recession was beginning to, kind of reaching that point where it was healing and we were coming out the other side. And of course, there's lots of distress in the real estate market, and these guys were looking to take advantage of it. So for us, with the experience of running, investment funds ourselves and kind of being students of that, we started an advisory and consulting practice where we actually helped, them to, form their own pooled investment vehicles and make sure that they were structured in a way that they'd be aligned and that investors would be interested, or as interested as possible in investing in the particular strategy. And then, of course, also helping them, these real estate guys understand these more sophisticated investment, vehicles, right? And all the things that go with it. And sort of that's what led to what I call kind of the accidental business, which is, now referred to as Verivest, is that, many of them, they now had these investment vehicles, but how are they going to do all of this, the administration and accounting for these things? And that's where, I kind of got involved in that. So the consultation and then the starting to actually provide that type of service to these clients where we would administer their funds on their behalf. So we took what was an internal department and made it a external facing division. And we actually then spun that out as its own company in 2017. So, from being in the perspective of, a fund administrator and having, now it's over 200 different entities that we administer. Right. I've seen a lot. So I've seen all sorts of strategies. Obviously, we've consulted on those. I've built financial models for many of those strategies, helped draft, term sheets and how they're structured. Right. So it ends up giving you this very unique perspective where you have to understand all of the securities laws and regulations. You obviously have to understand, accounting, and GAAP and all of those sorts of things, tax and GAAP accounting or the audit side of the business. Obviously, all the regulatory requirements that come along with, these sort of the sale of what are ultimately exempt securities. So you got that legal side, and then, being a sponsor ourselves, like I said, seeing all these things. So it's a unique skill set and experience that, many don't have, that I happen to have. And so I've seen lots of interesting things and continue to be a part of very interesting things. So the good news for me is that, I do spend most of my time in that role of the service provider. And in our case, specifically at Verivest, is really more of what I call the referee of the space, right? It's our job to make sure that everything is being done according to what the limited partners or, the members of, or the partners of these partnerships and the general partners or the manager, those who have the decision-making authority, they've agreed to something in the operating agreement for that partnership. And our job is just to make sure that it's all being done, as to what's been agreed, right? So, although I have the inherent conflict of interest that, Fairway America, I have an ownership stake in that, I'm not really involved in the day-to-day with that. I spend my sole time sort of making sure that all these things are happening. And so I think that, that's once again that unique perspective. And if I'm good at anything else, I guess it's the ability to sort of, take on certain, put on certain hats and make sure that I'm looking at it from a certain perspective. So that's generally what we do. And those are the things that I'll help to kind of share. And I think it leads into as well, what's the purpose behind this, in the name in particular. We named it Real Estate Risk Report. It was important to me that the word risk showed up in the title. It's one of those things that I've realized as I've been in this business that, most of the participants don't want to really spend a bunch of time discussing risk, although it really is. So they don't want to talk about it, but it really is ultimately all that anyone does think about. And so I'll never forget when I first got into this space in 2008, one of the first things that they did, Matt, he said, here's the private placement memorandum for, Fund 2 and Fund 3, and, read this, and, here's the private placement memorandum for this other fund that, was being managed by, some other manager in the local area or whatever. And, never read a private placement memorandum, didn't even know what a private placement memorandum was. Well, I quickly learned that it's basically the sales document, right? This is the document that's pitching me on why I should invest my hard-earned money into this particular, opportunity. One of the things I noticed right away was that, these risk factors were listed quite prominently, toward the front of the document. And so, my first reaction was, wow, this is like talking me into all the reasons why I shouldn't invest. Very interesting. So if this was a sales document, it's not doing a very good job of it. Kind of reminded me of the drug commercials on TV that, it's hard to differentiate between what the benefit of said drug was from all of the things it tells me that may happen to me. Right. And it makes sense. And I think that was when I began to realize that, this is important. Obviously, this is all about disclosure, right? That the person that you're selling this to needs to understand, and it's the duty of the investment sponsor and their legal counsel to ensure that you are completely aware of everything bad that could happen to you. And obviously, as well as, the thing that I want to talk about is all the great things that could happen because of the investment being made. And I think at that time, being more of, once again, the entrepreneur, I always kind of was thinking, well, why don't they just move the risk disclosures to the bottom of the document, right? Like, let's not spend a bunch of time talking about what can go wrong, and oftentimes that is where they can be found, is at the back of the document. So of course, now being a grizzled veteran in the space, that's pretty much immediately where I turn to, is sort of, what are the risks, and these are the things that I'll share with you as to how I guess I go about looking at these sorts of investments and what my eyes are drawn to, and hopefully that will be helpful for you. But I guess for me, once again, is given the, aside from the conflict of interest that I have with the Fairway America side, I really have the desire to kind of lean into this discussion around risk, because, my belief is that ultimately that's where, that's just what you have to do. I mean, there's risk in, everything you do, and you need to contemplate it. In fact, I believe that's kind of, for an investor, that's ultimately what investing is, period. Right. End of story. I mean, it's your ability to understand those risks and to, think through them and then make your decision based upon that. And we'll go into, more of that. I mean, when you look at, what is risk? I mean, fundamentally, it is the likelihood that, some unintended consequence could occur, rather than whatever your desired outcome is. It's the possibility that something bad could happen. Like I always say, it's like, UPS drivers, they avoid making left-hand turns because you have to cross traffic, right? So, they take as many right-hand turns as they can. That's just a way of mitigating risk. I picked up on that and kind of thought that makes a lot of sense, right? I do the same thing. On the way home, there's a way that I can take a right-hand turn and avoid, having to turn on the left, oncoming traffic. I tend to do it. It's like, well, why not? I got a wife and 5 kids, right? I might as well reduce the risk of something bad happening to me, right? Just as an example. And I think that, in finance in general or in investing, it's just, risk is the degree of uncertainty, and it's the financial loss that could occur, within any given investment decision, right? But it's just important to realize that risk is inherent, it's unavoidable, and that there's no such thing as a risk-free investment. So you as an investor, and I think, it's just that's what it's all about. And going back to the top, like I said, is that going from ignorant to enlightened, those who are in the ignorant category, their way of mitigating the risk is to not participate, right? And so that's prudent, because the risk is high because of their own ignorance. They don't have enough information to make, good decisions, right? And investment decisions. So they're better off not participating. It's just like me. I'm not a gambler. I'm not good at cards. I don't enjoy cards. It's not that I can't play. It's just that the way I look at it is that it's my money and I'm putting on the line, and I don't like the odds. I can't. My skill isn't there, and I can't mitigate the risk. If I wanted to be a gambler for money or play cards or whatever, then I would have to invest more time playing without without playing for money or whatever the case is, right? So that's what I'm trying to do here. Hopefully we can just lean into it, not be afraid of risk. It's not a taboo topic. Let's talk about it. And I think that it will change your perspective and give you a different lens at how you look at these things. And so I think too, for today, like just at a high level to talk about, right? So we got this notion of risk, right? And so I think that to me, I mainly look at risk as, it's especially in real estate in particular, is that if it's backed by real estate collateral, it's a tangible item, right? And so I should be able to mitigate enough risk to where the risk of principal loss is much lower, right? So because there's something there of intrinsic value. So when I frame this as, how can you lose money investing passively in real estate? I think that it's not an infinite number of ways that you can lose money, right? It's more of a finite number of ways. And I think it's important to not lose sight of that. So as we frame, what will be, subsequent episodes and, everything we're going to talk about on this particular show, I just think it's there. The good news is that there's a couple of things that are fundamental in my own mind, in the way that I look at it. And so, number one, and you'll hear this over and over and over again if you've been in this space long enough, it's the notion of, you make money in real estate on the buy. And by that, they just mean that when you decide to purchase some piece of real estate, it's more than likely the outcome is sort of, locked in at that moment in time. Because if you overpay for that piece of real estate, there's a good chance that the amount of time that you may have to wait, for some other outcome to happen, I mean, you start to stack the deck, against you, nearly immediately, right? And so that is what you hear everyone saying, and oftentimes they're going to anchor that against sort of what is the cost, what is the replacement cost of the asset that I'm buying, meaning how much would it cost to build that piece of real estate, or to net new, like what would the cost be? And so oftentimes you're hearing people that they mitigate that risk of overpaying by hoping that whatever they're paying for the real estate is something less than it would cost to replace it today, right, to build it from scratch. And obviously if it's a development deal, then that's the whole thing too, is just looking at it like, that's why development deals or ground up construction is just inherently more risk associated with it, because you hope that your budget is right and you hope that the cost ultimately of constructing that building is less than what one could buy it for in the open market, right? So anyway, those are more complex things, but just thinking of it simply, it's if people are overpaying for real estate, you could be sunk right away, and that could cause you to lose money. And I think that the one that really can exacerbate that would be kind of the second way you lose money, right? Is that if you're borrowing, if you're subordinating your position, meaning that someone is borrowing some amount of money to purchase that real estate, right? And they end up borrowing, the percentage of the amount that they borrowed, right? Or also known as the loan to the value or the loan to the cost. is too high, and that means the amount of equity that you've invested in that first loss position, right, is that should the real estate, it turns out that, hey, we overpaid for it. The bank somehow was fine with that, and they called that, loan to value, but that wasn't right. Right. And then, some sort of pandemic or whatever, right? The market moves against you for one reason or another, or all the tenants move out or whatever the case is that causes the value of the asset to decline. That might make that person who borrowed the money to help buy it, that senior to you, decide that, you've bust a covenant or something. So that's when people speak, they call that leverage, right? So that's the financial leverage, which is usually, hey, if I can, borrow money at some lesser interest rate, in a senior position, right, then that should create some sort of financial leverage and juice the returns. And often in real estate, that is the case, right? That if someone's claiming that they can deliver you a 14% annualized return, or whatever, more often than not, it's, that's a levered return. I mean, it just all depends, right? You've got to, what would the return be without that, the cheaper cost of capital, unlevered, or what would it be with the leverage? So, I think that's, another way is just that, they foreclose out on you, which is why that's something that you have to pay attention to. More broadly, one would just say, how is the particular real estate being capitalized in general, right? So, and if how could that affect you? But once again, that is a way, if it's all cash and you're in everything, the chances of you losing the entire investment in the long run, it just goes down because the value might go down. So you might be, you still own the real estate, but it doesn't necessarily mean that, that you're sunk. You could ride it out. Real estate generally over a long period of time will appreciate in value, right? And so you might be able to kind of come out the other way. I think that the way that, another way, obviously, that you could lose money, is things that obviously can be easily mitigated, but it's things like forgetting to pay the insurance premium, like the property insurance, right? I mean, it's, as we've seen, natural disasters are a real thing. They happen, flooding, fire, earthquakes, what tornadoes, whatever, right? And so, that if the property is not insured, that's probably, that can happen. Things happen. Once again, there's risk. That's why you have insurance. So you pay the money so that if something like that were to happen, you're covered. But once again, if it could be a simple, clerical error. Now, especially if you own it free and clear, it's incumbent upon you to monitor it. Most often is the case is if you've borrowed some amount of money, that lender is also, once again, they're very interested in making sure the property's insured. They're going to monitor it and they're going to probably, catch it for you. But just realizing that's how you can lose money. And these are things at times where, no one, I can't even recall a time where someone's really asking questions about insurance or even to see the insurance policy. But it's when you think about it, a lot of this common sense, but that is a way that you can, you could lose all your money or a good chunk of it. Right. And then I think the one, in my opinion, that would keep me up more than anything and maybe biased in this, but it's ultimately, if you're investing passively, you're investing into some deal that more than likely you don't really have. You have very limited control over, right? You don't have decision-making authority. That's why they call them limited partners, is that you basically don't have a say in what goes on. And what is more likely to happen when you look at any sort of, many of the sort of Ponzi schemes and fraud schemes that have been perpetrated, over the years, it's in these sorts of situations is that the person that you're investing the money with decides that they're going to misappropriate the funds and or assets, the money, the assets, whether it's cash or it's the assets themselves, rather than actually doing what they told you they were going to do, right? And so, to me, that's the most terrifying thing because, most of the people that have perpetrated frauds is that they didn't wake up one, morning and decide that they were going to start to, do fraudulent things more often than not, right? So they usually start out, have every intention of doing the right thing. And at some point, some event occurs and the situations change and maybe they've, once again, they overpaid for the real estate or who knows whatever happened. And they decide to start hiding things or they decide to start forging documents. They decide to do those things. It's that, that is the big risk. And when those things happen, that is, probably the most likely situation, of you really having a complete loss of funds, right? It's just that you entrust in the wrong people to do it. And so, there's, once again, that's a risk. But the beauty of it is there's a way to mitigate it. And for us at Verivest, as an example, that's what we do. As I said, our job is to sort of be the referee and make sure that everyone is doing things above board. But I think going into it to say, okay, like that's kind of how I could lose money. The rest of it, once again, is just it's figuring out whether or not those specific investments or those people that are, those sponsors that are making the investments know what they're doing, right? Are they buying good real estate or not? Is it a good strategy or not? And these are all the things that we'll talk about over the course of, the remaining episodes, is just bringing, light to these various strategies and the different property types and the risks that are inherent to different strategies and different property types and those things. Like I say, it's not infinite. That's the good news. It's just having it laid out for you so that you can start to, understand how to, assess and evaluate these specific situations and know the right questions to ask will put you on that path to becoming enlightened. So that's just sort of wanted to set the stage for that, right? As just the, who I am, why I'm here, why this whole risk thing. It's I'm a bit nerdy on it. But that's just how I look at it, right? Is just it's risk is inherent, and ultimately the objective is to figure out how to assess what those risks are and to assign, a premium to those risks, right? To arrive at some sort of sense of what you believe, an above average risk adjusted return would be, right? So it's not just to say that if someone's offering you a 12% return, that without all the context of the situation, it means nothing to me, right? Like, and sometimes that's what happens, right? Is that people are afraid, because let's just say that particular strategy, let's just say that it's something that really, the true risk adjusted return should be 30%. Well, oftentimes what, deal sponsors, they realize that if they were to say 30%, then most people would be like, that must be way too good to be true. So then they reprice it at 12 because people don't know all the stuff that we're going to talk about on this show. And they still think that 12 is good, but it doesn't sound too risky, right? And so that's the sort of behavior that I'm hoping that we can, begin to eradicate. And just in terms of like that stuff shouldn't go on. And that's not a good way to think of it. You need to assess the component parts. And once again, and to the degree that someone needs capital to execute a strategy that has the potential, once again, where there's consummate risk involved, then you should be, that's not to say that that's the wrong investment for you, but you should be compensated for the risk that you're taking, right? And that's just how it should be, right? And obviously, the more people that really can appreciate and can analyze and assess the risks that are inherent and how much of a premium they should put on those risks, then you end up having a more efficient, market, right? More people can participate, and the beauty of sort of this middle market real estate space, in my opinion, is that fragmentation's a feature, right? So it's unlike the public markets that are liquid and you can buy and sell stock and, all of those things sort of, go on. And there's people, setting prices. That real estate is inherently illiquid. And most of the real estate it's not giant skyscrapers that we've all heard of, like the Empire State Building, or, they're not huge. The vast majority of real estate is spread, far and wide in this country. And there's plenty of opportunities and therefore it makes it inefficient, which means that there's potential to generate outsized risk-adjusted returns, right? So that's the whole point of this, is that it behooves people to at least understand this stuff to the degree, once again, that you have wealth that you could invest into these things, because you have the possibility of generating outsized returns. and that's great, right? And especially obviously as we know, it's you're always working against inflation. Inflation is real, it's there, and so our money doesn't go as far. So you have to be the wealth that you have accumulated, you clearly want to be putting it into things that can help you, clear that inflation hurdle, so that you can get ahead. Now, it's easier said than done, of course, but that's what we intend to do here. So anyway, I'm super excited about it. So the format and the frequency, I kind of alluded to it earlier. So the frequency for now is just, we'll do one of these a week. Maybe we can go more frequent than that, but it's stick to one a week. And then so really the way that this will work is that we'll be hitting on some sort of educational topic, or what I kind of call the grammar, the grammar of this private placement middle market real estate ecosystem. So even in today's episode, it's hard. It's the first. I've said a bunch of things that maybe you don't even know what they are. I'm going to do my best to sort of, like I said, cookies on the bottom shelf. It's the objective. Teach you the grammar of the space. And, so we'll be hitting, some episode might be, that's all it is, just like today, just like, what is risk? How can we lose money? Let's just let's orient ourselves to sort of high level stuff. Second thing is we'll probably running through some case studies of sort of these frauds that have been perpetrated, in the space over the years. I think it's instructive, right, to see how others have, done bad things to people, right? And obviously you can learn how to avoid those things by studying them. So it's good to kind of look at what's happened and how did they do that, and what could you have done differently. I mean, it's hard to grasp, right? But the whole Bernie Madoff Ponzi scheme could have been really could have it could have been handled much differently. Could have went in completely different directions had someone just called the depository and trust company and asked to actually have them confirm that these trades that Madoff Securities was making were legitimate, right? And there were several times when that nearly happened, but it didn't, right? And so just something as simple as asset verification, ensuring that the assets that are being claimed, is real. So we're going to do that. Case studies, they're good, they're interesting. And then we'll have guest interviews with other passive investors. So people like yourselves that are doing this and kind of how they approach it is always interesting. And then many of the guests will actually be active real estate investors, or what we're calling sponsors. So sponsor is anyone who sort of is allowing you to participate in whatever they're doing, right? They're sponsoring some investment. That's just a very broad, generic term, what we'll call. So getting insight from these others as to, what they're doing and how their strategy works. And, that's how, once again, understanding how these returns can be generated is very important. And then hearing it right from the mouths of those who are doing it actively. And then, of course, just the ways that, it's as much as their process and that their own due diligence process and their underwriting process, to how they determine whether or not, they're buying at the right price, and how they determine and execute, that strategy, and how they mitigate risk along the way. I think it's interesting and kind of gets you inside the mind of someone who, more than likely isn't necessarily thinking of that, or can maybe articulate it as easily if asked. So it should be good to have some guests on. So anyway, that's today's episode. Covered lots of ground. Like I said, I'm looking forward to it. We've got a lot of good stuff already kind of in the can, so there'll be some good episodes coming up here. So stay tuned, and until next time. All right, take care.